Welcome back to the Daily Crypto Deep Dive. Today we're running a serious 2030 simulation. Not hype, not moon math, not social media fantasy. This is a structured breakdown of what a $10,000 investment today could realistically look like by the year 2030 across Bitcoin, Ethereum, Solana, and XRP, using current prices, historical volatility data, institutional research frameworks, and known supply mechanics like the halving cycle. Every scenario in this episode is based on evidence available today. If that evidence changes, the probabilities change. That's the discipline. Right now, Bitcoin is trading in the mid-$60,000 range. Ethereum is just under $2,000. Solana sits in the low 80s. XRP is around $1.40. Those are our starting coordinates. But before we simulate anything, we need to acknowledge something most people ignore. Crypto is not a straight line to 2030. Historically, Bitcoin has experienced multiple drawdowns of 70% or more. Ethereum has fallen over 90% in past cycles. Solana has collapsed more than 90% before recovering. That is not theory. That is documented history. So any realistic 2030 model must assume brutal volatility between now and then. Bitcoin's most important characteristic is fixed supply. There will only ever be 21 million Bitcoin. That constraint is coded into the protocol. It is not subject to board meetings or monetary committees. Every 4 years, roughly, the issuance rate is cut in half. The next halving is expected around 2028, which will reduce the block reward again and slow new supply entering the market. This declining issuance model creates a mathematically tightening supply environment over time. That does not guarantee price appreciation, but it does create a structural scarcity dynamic that traditional assets do not have. Institutional firms model Bitcoin differently than retail traders. They examine addressable markets. They compare Bitcoin to gold, to sovereign bonds, to global monetary bases. ARK Invest has published long-term scenarios that stretch from around $300,000 on the conservative side to well over $1 million in aggressive adoption cases by 2030. Standard Chartered has outlined long-term projections around the $500,000 mark under certain capital flow assumptions. These are not promises. They are frameworks built on assumptions about ETF inflows, corporate treasury adoption, and sovereign diversification. At approximately $66,000 per Bitcoin today, $10,000 buys about 0.15 Bitcoin. Now let's apply structured scenarios. In a conservative 2030 case where Bitcoin reaches $300,000, reflecting adoption but not global monetary dominance, that $10,000 becomes roughly $45,000. That represents strong growth, but not fantasy. In a mid-range scenario around $500,000, that same $10,000 grows to about $75,000. In a higher base case around $700,000, you're looking at approximately $105,000. And in a highly aggressive institutional adoption case of $1.5 million, the value exceeds $200,000. But here's the critical context. None of those numbers arrive in a straight line. Between now and 2030, we will almost certainly experience liquidity contractions, policy shifts, risk-off cycles, and potentially regulatory surprises. The historical pattern shows that long-term appreciation in Bitcoin has been punctuated by violent corrections. So the true risk isn't, will Bitcoin reach $500,000? The real risk is whether you survive the 60% drawdown that might happen before it gets there. Now let's move to Ethereum, because Ethereum is structurally different. Ethereum's value proposition is not fixed supply. It is programmable finance infrastructure. It captures fees. It processes smart contracts. It enables decentralized finance and tokenization. After its transition to proof of stake, Ethereum's net issuance has become structurally different, especially when transaction burn rates increase during high usage periods. But Ethereum's long-term valuation depends on whether economic activity accrues to the base layer or migrates to layer 2 scaling networks. Institutional projections for Ethereum to 2030 vary widely. Some structured research models place Ethereum around $20,000 in a sustained adoption case. Others stretch toward $40,000 under a full institutional integration and ETF expansion framework. These valuations are based on transaction revenue capture, network dominance, and total value locked metrics, not emotional enthusiasm. At roughly $1,945 today, $10,000 buys just over 5 Ethereum. If Ethereum only reaches $6,000 by 2030, reflecting steady but unspectacular growth, that becomes roughly $30,000. If it reaches $22,000, that becomes over $110,000. If it reaches $40,000, the value crosses $200,000. But here is the nuance. Ethereum's upside is highly sensitive to competition. If Solana, alternative chains, or new scaling solutions dilute Ethereum's revenue capture, that affects long-term valuation. Ethereum is not simply a scarcity bet. It is a productivity and market share bet. Now Solana. Solana represents high beta exposure to crypto growth. It offers speed and low transaction costs. It has experienced dramatic adoption bursts, particularly during NFT and meme coin cycles. But it has also experienced outages and sharp corrections. Institutional scenario modeling for Solana has been extremely wide, from very conservative low double digits to projections above $2,000 under aggressive adoption assumptions. At around $81 today, $10,000 buys approximately 123 Solana tokens. In a modest 2030 case where Solana reaches $335, reflecting growth but not dominance, that investment becomes about $41,000. In a stronger case at $2,000, it becomes roughly $245,000. In more aggressive projections beyond that, the upside expands further. But the probability distribution is wider. High beta means higher variance. It means Solana could underperform for years if adoption shifts or if regulatory frameworks disadvantage its ecosystem. XRP's thesis is built on financial settlement efficiency and institutional integration. Its long-term value depends heavily on real-world usage in cross-border payments and liquidity provisioning. Some long-term institutional commentary has floated high double-digit targets by 2030 under strong adoption cases. But XRP's future is uniquely tied to regulatory clarity and institutional partnership expansion. At $1.40 today, $10,000 buys roughly 7,000 XRP. In a modest 2030 scenario where XRP reaches $2.50, that becomes about $17,500. In a stronger scenario at $10, it approaches $70,000. In a high adoption case at $28, it approaches $200,000. But unlike Bitcoin's supply-driven thesis, XRP's case hinges on usage and integration metrics that are more difficult to measure in advance. Now let's simulate diversification. If you split $10,000 equally into Bitcoin, Ethereum, Solana, and XRP, $2,500 each, you reduce single asset risk. In a conservative 2030 case where Bitcoin grows moderately, Ethereum performs steadily, Solana underperforms, and XRP grows modestly, that basket could reach roughly $20,000 to $30,000. In a base adoption scenario where Bitcoin approaches mid-six figures, Ethereum captures value, Solana gains share, and XRP integrates further into payment rails. That basket could approach $80,000 to $100,000. In a strong institutional bull case across the board, that diversified portfolio could exceed $200,000. But here's the psychological reality. The most difficult part of a 2030 thesis is not the math. It is the endurance. Between now and 2030, we could see recessions. We could see rate tightening. We could see ETF inflow slowdowns. We could see over-leverage unwind. If you panic sell during a 50% drawdown, the 2030 scenario becomes irrelevant. So what are the cold conclusions? First, long-term upside cases are supported by institutional modeling and structural supply mechanics, particularly for Bitcoin. Second, Ethereum's long-term outcome depends on economic capture, not just price momentum. Third, Solana offers asymmetric upside but carries asymmetric risk. Fourth, XRP's trajectory depends heavily on regulatory and institutional execution. And finally, none of these projections eliminate volatility. This entire episode is a simulation based on evidence available today. Fixed supply caps, halving schedules, institutional research frameworks, and historical volatility patterns. It is not financial advice, it is not certainty. It is a structured way to think about probability. If you are building toward 2030, your edge will not come from guessing the perfect price. It will come from discipline, risk sizing, and emotional resilience through cycles. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.